Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Matt Patterson, co-founder of Handles Indexes, to discuss quarter income investing activity and outlook, as well as the 7-handle index. Matt, it's great to see you again. Welcome back to Trade Talks.
Thank you, Jill. Great to see you.
And Matt, let's review income investing activity that we've seen so far through the first quarter.
Yeah, I think the big story in the first quarter of 2021 was interest rates. If we go back to the beginning of the fourth quarter of 2020, we saw the 10-year Treasury was trading at 0.69%. Throughout the fourth quarter, it backed up and finished the year at about 0.93%. And in the wake of the presidential election, the two Georgia Senate runoff elections, and then the successful passage of the Biden $1.9 billion stimulus package, we've seen rates on the 10-year Treasury back up to 1.63% as of March 15th. Bond investors are pricing in a strong COVID recovery and the impact of that stimulus package, and they think it's going to lead to more economic growth that's going to force the Fed to raise short-term rates sooner than they had previously anticipated. The question for investors is, will this be the year that the rising rates trade finally pays off? From a big picture perspective, the steepening yield curve had a big impact on income-oriented investing asset classes. In particular, every single fixed income category from January 1 through March 15th lost money, and it was a mixed bag for the rest of the asset categories.
And tell us about the Nasdaq 7-handle index and the methodology it follows.
So the Nasdaq 7-handle index is an index of ETF that is designed to provide high levels of monthly income to investors. And it consists of two portfolios. The first is what we call the core portfolio, and that it consists of a core equity component and a core fixed income component. And then the other portfolio is what we call the Dorsey Wright Explore portfolio, and that provides allocations to 12 different income-oriented asset categories that investors typically rely upon to generate high levels of income. And these include growth in income, MLPs, preferred securities, REITs, covered calls, dividend equities, utilities, active fixed income, high yield bonds, investment grade corporate bonds, mortgage-backed securities, and taxable munis.
And how are some of these categories performing, Matt?
So on the plus side, MLPs from January 1, and these are master limited partnerships that do provide exposure to energy. From January 1 through March 15th, MLPs were the best performing category of those 14 categories on both an absolute and a risk adjusted basis. It's worth noting, going back to the beginning of 2020, MLPs have been the best performing category of the 14 we track for 3 of those 5 quarters. And yet over that 5-quarter period, MLPs are also the worst performing category that we track. So this is an asset category that is extremely volatile, high risk, high reward. We think it still has a place in income investors' portfolios, but it should be part of a diversified portfolio. Another upside performer in the first quarter were REITs, which obviously were hit hard by the pandemic as the travel industry struggled and the commercial office space struggled. They were up 8% in the first quarter. As I mentioned, fixed income was down across the board. The worst performer on an absolute basis was investment grade corporate bonds, down over 4%. That is the worst start to the year for investment grade corporate bonds since 1996. And then the aggregate bond, or what we call core fixed income, also was down slightly below 4%. And on a risk adjusted basis, after taking volatility into account, the core fixed income was the worst performer in the first quarter through March 15th.
And finally, let's wrap with your second quarter income investing outlook.
Okay, so a lot is going to depend upon what happens with interest rates going forward. We have 2 factors working against each other here. Expectations of further economic growth are driving up interest rates. Bond investors think the Fed is going to have its hand called and it's going to have to raise rates sooner. The flip side is faster economic growth means faster corporate earnings, and more corporate earnings should be good for stocks. The problem is as interest rates go up, those future corporate earnings are getting discounted at higher rates. And right now, those higher rates are kind of dominating the expectations of future earnings growth. And you see that particularly in the high growth tech companies, because their future cash flows are concentrated further out in the long term. These types of companies are hit harder by rising interest rates because those earnings are being discounted further back and their present value is lower. And we've seen cyclical and value companies actually do very well in this environment because their cash flows are concentrated more near their near term. But for right now, Goldman's predicting 1.91% on the 10-year by the end of the year. Scott Meinert over at Guggenheim suggests we could have negative rates on the 10-year by 2022. So there's quite a dispersion of views on this. And obviously, the outcome for fixed income and equities will vary greatly depending upon what happens with the yield curve. And then the last thing to look forward, going forward, not necessarily the second quarter, but certainly the rest of 2021 concerns Joe Biden's tax proposal, which would raise rates on high income earners, as well as raise the corporate income tax rate. All else being equal, we would expect that to reduce after-tax returns on investment, and that should put downward pressure on equity valuations. What effect it would have on fixed income depends upon what type of spending package goes along with it and whether it's stimulative or contractionary. But certainly right now, given how tight the Senate is, it's not clear that the likelihood of passage of that tax proposal is very high.
All right, Matt, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.